Good morning. On today's episode, we'll be looking at introduction to bookkeeping and financial accounting. So let's begin. Introduction. Introduction to bookkeeping and financial accounting. Financial accounting. So, uh, bookkeeping is a subcomponent of financial accounting. Financial accounting is a subcomponent of accountancy or accounting as a field or a profession. So let's begin by defining bookkeeping. What bookkeeping means actually. So bookkeeping is defined as is simply defined as the recording of business transactions as they occur on daily basis in a systematic and orderly manner in order to show the true position of the business. So bookkeeping is defined as the recording of business transactions as they occur on daily basis, as they occur on daily basis, daily basis in a systematic, in a systematic and an orderly manner to show the true position, the true position of the business, the true position of the business. So this is the definition you could likely give when you're writing or you're taking any exam. Now, let's explain some of the keywords in this definition of bookkeeping. So let's start with recording. What are we recording, or what does record means? Recording means to write a business transaction, to write it down. So in any business organization, when you see some of the staff engage in act of writing, then we say that is what? Act of what? Bookkeeping. So what are they writing down? It's what? It's business what? Transaction. Now, as they occur on daily what? Basis. As they occur on daily basis means the date the transactions occur. You have to write it because in accounting we cherish the date of every transaction a lot. So the dates that the transaction occur, let's say a transaction occurs today, let's say 26 of, let's say August, 26th of August, let's say 2603, or let's say March 2024. So this is the date the transaction occurs. So you have to state it, which means what? Which this daily basis means. So recording of business transaction as they occur on daily basis. Then in a systematic, in a more professional way, you have to record those business what? Transactions. Then to show the true position of the business. That means the basis of or the reason why you are recording business transaction is to determine at the end of the period whether the business is making profits or not, and that's the true position of the business. You want to determine whether the business is profitable or not. That's why we do in accounting or bookkeeping recording of what? Of business transaction. Now, let's shed more light on business transaction. Business transaction, or you can call it financial transaction. It simply means the economic activity in a business organization that involves the exchange of value between a knowledgeable buyer and a knowledgeable seller at arm's length. At arm's length means at a distance. Let's say, for example, you are buying goods from Dangote, you're buying cement, let's say bags of cement, or you're buying, let's say, 120 units of boku bread. That's also what a business what transaction. So business transaction involves the exchange of value between a knowledgeable buyer and a knowledgeable seller at arm's length. Now, this business transaction can be classified into two. Let's say we have two types of business transaction, two types. So we have types and we also have forms of business transaction. With respect to types of business transaction, we have two. And with respect to form also, we have two forms. So two types, we have cash business transaction and we also have credit business transaction. When we say transaction is cash, it means payment is made or immediate payment is made for that business or transaction. That means at the point of purchase, we are paying either by cash or by check. That's cash transactions. And you all know any cash transaction will find that destination in cash book. That's where you will record all cash transactions. So cash book is a subsidiary book where all cash transactions are recorded, whether you receive cash or you pay cash. Credit transaction, on the other hand, it means a transaction occurs now, then you are making payment at a future date. That means you buy today, then you are paying tomorrow or next week or next month, like that, like that. So credit transaction, we are going to talk about that because there's other subsidiary books where that can be recorded too. That's sales day book or sales journal and purchases day book or purchases journal. That means purchases day book, for example, when you buy goods on credit, you record it in purchases day book. And when you sell goods on credit, you record it in sales day book or sales journal. So that's with respect to types of business transaction. Then let's go to forms of business transaction. We have two forms basically. We have formal business transaction and we have informal business transaction. From the word formal business transaction, let me put it this way. Formal business transaction is usually between an individual and a business organization or between business organization and business organization. Let's say individual, me buying goods from Dangote. That's formal business transaction. Because in the process of transacting, there will always be a document that serves as what? Evidence. And that document that is often generated in a business transaction is called source document. Source documents, they provide evidence about a transaction that has taken place between a knowledgeable buyer and a knowledgeable seller. And a good example is receipts. Examples of source document is what? Receipts. Receipts provides evidence about the transaction that has taken place between a buyer and a seller. Just like every other source document, some of their characteristics include they provide the dates or they indicate the day the transaction occurred, the dates. They indicate the amount involved, the name of the business organization, and so on and so forth. So formal business transaction is between an individual and a business organization or between a business organization and another business organization. Let's say Dangote depositing money in GT Bank or Zenith Bank. That's business organizations transacting business. That's it's still formal because in the process of it, formal documents or source documents will be generated in the process. Then informal business transaction on the other hand, it's between individuals and in the process of it, no source documents, no documents of evidence will be generated in the process of informal business transaction. So those are the forms of business transaction, formal and informal. But with respect to types, we have cash and credit. Now, I think I've been able to explain what bookkeeping means. So bookkeeping simply means recording of business transaction. And when you record, you are writing it down or you are documenting it. Another word for recording is document. When you document, you write. So that's basically what bookkeeping is about. Then let's move to financial accounting. Excuse me. So financial accounting, financial accounting. Let's talk about financial accounting. Financial accounting, like I said, it's one of the branches of accounting. We have lots of branches of accounting, but one of them is financial accounting. Now, financial accounting, or let me just say financial, is the language of every business. Yeah, every business must make use of financial accounting terminologies. So, financial accounting, I will define it as the collecting, recording, classifying, classifying, summarizing, summarizing, interpreting, interpreting, and communicating, and communicating business transactions, business transactions to the users, to the users of financial statements, to the users of financial statements, financial statements, financial statements to make informed decision, informed decisions. So when we say financial accounting, what that means is, because the basis of financial accounting is to give stewardship of resources. Give stewardship means give account of the resources that have been committed in the hands of the management for the past 12 months. And 12 months is the accounting year. So when resources is being committed in the hands of the management, they have to give account of that. So giving account of that stewardship is about what? Financial accounting. So financial accounting is defined as the collecting, recording, classifying, summarizing, interpreting, and communicating business transactions to the users of financial statements for them to make decisions. So this is basically the standard definition you would ever give when taking any exam. Now, like I did say, the basic difference between bookkeeping and accounting is that bookkeeping simply talks about recording of business transaction. Then financial accounting deals with interpreting and communicating that business transaction to the users of financial statements so that they can make decisions. Now, when we talk of the highlights of this definition, you can talk about collecting, you can talk about recording, you can talk about classifying, then basically interpreting, communicating business transaction, then communicating and what? Interpreting the business transactions to the users of financial statements for them to make decision. Now, it is the basic responsibility of a financial accountant in every organization to prepare the financial statements. Then, when that financial statement is being prepared by the financial accountant, then such statements, which we call financial statements or the annual report of every business organization. Another word for financial statement is annual report or financial information. That financial information will now be used to make different decisions by different users of financial statements. So, number one, it is the basic duty of or the responsibility of the financial accountant to prepare the financial statements. Then, who are these users that are going to make use of these financial statements to make what? Informed decisions. We call them users of financial statements. But before we get to that users of financial statements, let's talk about the phases or stages of financial accounting. Let's talk about that. After which we come to the users of financial statements. So, excuse me. So, phases, phases of financial accounting. Phases. Another word for phases is stages. Stages of financial accounting. Financial accounting. There are four phases. Let me start with collecting phase. Collecting phase. Collecting phase. Then we have number two. We have recording phase. Recording phase. Then number three, we have presentation phase. Phase. Presentation phase. Then we have number four, which is last but not least, we have analyzing, 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 and interpretation phase. So these are the phases of financial accounting. Then what do you mean by phases of financial accounting? Very simple. We mean before the financial statements of a business organization will be ready for use by the users of financial statements. What are those phases? What are those stages? What are those processes that the financial accountants will go through, will undergo before that annual report or financial statement will be ready for use by these users of financial statements? So these are the phases. Then number one, we have collecting phase. Although most times bookkeeping is done by the junior accountants in every business organization, but preparing the financial statement or annual report of a business organization is done by the senior accountant, most times chartered accountants. So collecting phase. Collecting phase simply explains where the business transactions are usually obtained. From the word collecting, where do you usually get the business transactions? Then the business transaction, like we said, they are often gotten or captured or obtained from the source documents. So source documents are those documents from which business transactions are obtained. Then example, we have receipts. Because source document is a topic which we are going to be treating on its own. We have receipts, we have voucher, we have debit notes, we have credit notes, we have statements of accounts, we have invoice, we have check, we have check stub, and so on and so forth. So those are source documents from which the business transactions will be collected or financial transactions will be obtained or captured. Then after these source documents, after the business transactions have been obtained from the source documents, then they will now be subsequently recorded in the subsidiary books. Then that leads us to recording phase. So recording phase simply explains the fact that you have obtained the business transaction from the source documents, then you have to record it in the appropriate subsidiary books. That means by classifying those financial transactions or business transactions in their respective books of accounts. Then subsidiary books, subsidiary books. That is where, okay, let me explain this. Subsidiary books, that's where the business transactions are usually recorded. And subsidiary books are also called books of original entry or books of prime entry. Books of prime entry. And we have basically books of prime entry or books of original entry. That's another word for subsidiary books, where transactions are often recorded. Immediately they are obtained from the source documents. Then we have 6 of them. We have cash book. Cash book. So don't forget, we said in this recording phase, we are trying to classify those business transactions into their respective books of accounts. So we have cash book, number one. We have number two, we have purchases day book. Purchases day book, purchases day book. Then we have number three, we have sales day book, sales day book. Then number four, we have return inward day book. Return inward day book, excuse me. Don't forget, I've written all those pages. I'll write them again. Return inward day book. Then number five, we have return outward. Return outward day book. Then we have the last but not least, which is general journal. General journal. So these are the 6 subsidiary books where business transactions are going to be recorded when they are obtained from the source document. So cash book, what is the function of the cash book? It is used to record any cash transactions. Cash transaction means whether you are paying by cash or you are receiving by cash, or whether you are paying by check or you are receiving by check. So cash transaction, not basically cash transaction or anything that has to do with check too, whether customer is paying by check or you are buying by check or you are receiving by check, like that. So any form of cash transactions, we find their destination in the cash book. So cash book is a subsidiary book or book of original entry that is used to record cash transactions, whether cash received or cash paid. Then number two, we have purchases day book. Another one for purchases day book is purchases journal. Purchases journal. Purchases journal. It is a subsidiary book or book of original entry that is used to record goods bought on credit. So when you buy goods on credit, you are not paying now. You record it in the purchases day book or purchases journal. That's another one for purchases day book. Then the next one, sales day book. Sales day book is the book of original entry or subsidiary book that is used to record goods sold on credit. So as a business, you buy on credit, you record it in purchases day book. But when you now sell on credit to your customers, then you record it in the sales day book or sales journal. Sales journal. Then the next one, return inward day book. Now, there are times that you sell goods to customers and some of them are not good. So those customers returned the goods to you. Where would you record it? Is what? Return inward day book. Now, those goods that the customer returned are called return inwards. Goods that customer returned to you that are not in good condition, of which you have sold to them, they are called return inwards. Then those return inwards will now be recorded in the return inward day book. Then the next one, return outward day book. Now you are the one buying from the supplier. Then some of the goods are not in good condition. So when you return it to the supplier, where are you going to record it? Return outward day book. Then those goods that you return to the supplier, they are called return outwards. So goods that are not in good condition that are returned to the supplier are called return outwards. And return outwards are going to be recorded in return outward day book or return outward journal. Return outward journal. That's another word you can call return outward day book. And this one, return inward day book, you can call it return inward journal. Then the last but not least, which is what? General what? Journal. It's also called journal proper. You can call it journal proper. That's another word for general journal. Journal proper. It is one of the, we have two principal books of accounts. We have general journal and we have ledger. The reason why they are called principal books of account is because they can be used to record all other transactions that cannot be recorded in other subsidiary books. So for general journal, it is used to record, let's say, business transactions that cannot be recorded in the first 5 subsidiary books. So any transactions you cannot record it because this is specifically for cash. For specifically for goods bought on credit, specifically for goods sold on credit, specifically for goods that customer return to us, specifically for goods that you return to the supplier. But this, there are some transactions that you cannot record here. So where would you record it? In the general journal. For example, so uses of journal now. That means what journal is used for. Number one is that it can be used to record the opening entries of the business. Opening entries of the business are those items you start your business with, like stock, debtors, assets, and so on and so forth. Then you can also use it to record the closing entries of the business. The difference between opening and closing is just that this one is opening, while this one is closing. So closing entries is still the same. What you end your business with at the end of the financial year, which is usually 12 months. So financial year or accounting year is 12 months. So the same. Then another uses of general journal is you can use it to record transfer of let's say balance from one account to another. If you want to record that, you make use of journal. That means you can use journal to effect the transfer of account balance from one account to another. Another use of journal is that you can use it for correction of error, or it is used for correction of errors. Then another one, let's say the owner of the business withdrew from the business or withdraws from the business. That is called drawings. So each time the owner of the business withdraws from the business, that is called drawings. And drawings will find themselves recorded in the general journal. And maybe assets bought on credits, because asset bought on credit cannot be recorded here. It's asset bought on cash or by check. That's what you recorded. But assets bought on credit will be recorded in the general journal. And assets sold on credit will also be recorded in the general journal. So those are some of the specific uses of general journal. So we are still on recording phase. So recording phase talks about the moment the business transaction is obtained from the source document, which is collecting phase, then you record them in the appropriate subsidiary books. So these are the subsidiary books or books of original entry. So let's go to presentation phase, which is the third phase of financial accounting. Excuse me. So presentation phase, that's the third phase of financial accounting. So presentation phase, that's number 3. Presentation phase. Presentation phase. So from the word presentation, all the business transactions for the year, they are going to be presented in form of statements, in form of accounts, just to determine the what, whether the business is now profitable or not. So presentation phase, the essence is we want to present all the business transaction in form of accounts or statements. So here, the financial accountants will prepare the financial statements, and financial statements can be used to show. So when we say financial statement, basically, it's like a book that contains all the accounts of a business organization for the financial year. So in financial statement, you will find some of the statements there, such as income statements, which is used to determine the profitability of the business. That means whether the business is making profit or not. Then we also have the financial position of the business, which is the balance sheet, which shows the assets and liability of the business at a particular date. Then you can also have cash flow statements. Cash flow statements will be in the financial statements. So cash flow statements can be used to determine the liquidity of the business as at a particular date, and some other statements. So presentation phase is about presenting all the business transaction in form of accounts or financial statement. Like I did say, financial statement is same thing as annual reports of a company. So each time you hear the annual report of a company, it means the whole accounts of a business organization for its financial year or for an accounting year. That's annual reports. So Echo Plus Aboy will be preparing its annual reports this year, December. So watch out for so that you'll be able to check our profitability and they play. So let's go. So that's presentation phase. What's the essence of presentation phase? To determine the profitability, to determine the liquidity of the business, to determine the uh, efficiency of the business, the financial state or affairs of the business, and some of the statements that will be prepared. We've talked about them. Income statement, which is the same thing as statements of profit or loss. Cash flow statements. Value added statements could also be prepared. Then you also talk about the statement of financial position, which is the balance sheet. So those are the statements that will be presented. Then the last but not least, which is we have the analyzing and interpretation phase. Interpretation phase. Now, the statements which have been presented, which is the annual report or financial statements, we have to be analyzed and interpreted. So, the summary that has been presented will be analyzed and interpreted by who? By the financial analysts. Financial analysts are experts, the accountants, they are experts. They are the one that are going to analyze. How do they analyze the financial statement? Analyze is more of extracting information from the financial statement in a way that will give the users of financial statement for them to make decisions. So the financial statement that has been presented by the financial accountants of the business organization will now be analyzed by the financial analyst. Then the financial analyst, most times, they analyze the financial statements using accounting ratio. There are various methods that can be used to analyze the financial statement. One of them is accounting ratio. One of them is experience. One of them is account method, and so on and so forth. So this accounting ratio is used by the financial analyst to analyze the financial statement with a view to helping the users of financial statement to make informed decision. Then after they've analyzed it, then they will now interpret it to the users of financial statement. That's the users of financial statement. Financial analysts will analyze and interpret the financial statement to the users of financial statement by making use of accounting ratio in order for the users to make informed decisions. And I did say that the financial analysts, they analyze the financial statement by making use of accounting ratio. Then accounting ratio, what's the essence of it? What will it show as regards the analyzing of the financial statement? Number one is that it will show the profitability of the business. So we have profitability ratio. Profitability ratio. We have it will show the liquidity of the business. That's this accounting ratio that is often used by these financial analysts to analyze the financial statement. So these are what the accounting ratio will show. One, profitability, how profitable the business has. Don't forget, the language of every business is profit. And so liquidity. Liquidity in terms of what the business is worth in terms of cash. The accounting ratio will show that. Then we have efficiency of the business, efficiency ratio. Yeah, efficiency ratio or efficiency of the business. So efficiency of the business, if you want to show that, you use what? Efficiency what? Ratio. Then we have the accounting ratio can also be used to determine or ascertain the long-term stability of the business. That means whether the business will be able to survive in the nearest future, whether the business is on a going concern or not. You know what it means for a business to be on a going concern? That means is the business or will the business be able to survive in the next 2-3 years? Are there no external threats to stop the line of the business in the nearer future? So when a business is going on or is on a going concern, it means the business is making a reasonable net amount of income and there is no external threats to stop its line of business. So these are some of what the accounting ratio will be used to determine by the financial analysts. We are going to be talking about them one after the other in our subsequent episodes. So the analyzing and interpretation phase, I did say the financial analyst will analyze the financial statement by making use of accounting ratio. Then accounting ratio can be used to determine the profitability, liquidity, efficiency, and long-term financial stability of the business. That means will the business be able to survive in the nearest future and all that. So these are some of the phases of financial accounting. So the phases, don't forget, collecting phase, from collecting to recording, from recording to presentation, then from presentation to analyzing and interpretation phase. So those are the phases of financial accounting. Should you ask to arrange them accordingly, these are the way they should be arranged. Then let's move to another interesting subtopic. Let's move to another interesting subtopic. So let's talk about, now we did say when the financial statement is prepared by the financial accountant, then such accounting information will now be used. That means that financial statement will be used by some users. We call them users of financial statement. So let's talk about uses, importance of bookkeeping or financial accounting. So let's talk about the uses. Let's say it's about 5 or 7 uses of bookkeeping. So uses of bookkeeping, 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 accounting information, or financial accounting. So let's talk about the uses or advantages or importance of this. It's the same. So should you ask in any exam? So number one is that, what's the importance of bookkeeping? That's recording business transactions. Accounting information. When we say accounting information, the income statement, which is statement of profit or loss, that's accounting information. Of balance sheet, that's statement of financial position. Or financial accounting as a sub of accountancy, as a word, as a field, or as a word. Let me put it that way. So number one is that it can be used to ascertain or determine whether the business is making profit or not. So that's number one. It is used to determine whether a business is a business is making profits, or loss. So all those business transactions will help us to know, after we've recorded them, it will help us to know whether our business is making profit or not. Number two, that bookkeeping, that recording of business transaction, it can help us, it can provide us the basis. It provides the basis for preparing the financial statements. It provides us the basis for preparing the financial statements. So all these recording, the transactions that we have, we can use it to prepare our financial statement. And financial statement is the accounts of a company. All the accounts of a company. It's called financial statements. Then number three, this financial statement which have been prepared, or accounting information, can be used to determine the tax liability. It is used to determine the tax liability of the business. So when the financial statement has been prepared, then it is on that basis that the tax authority will determine the tax liability of the business. So financial statement is a useful information. It's important to the business in terms of the tax liability of the business will be determined based on that. Then let's talk about number four. Number four. Number four. So number four, financial statements can be used to, okay, number four, financial statement can be used for planning purpose. Planning purpose. So you can use financial statement for planning purpose. That's number four. Then number five, financial statement can be used to determine the assets and liabilities of the business at a particular date. Liquidity of the business, efficiency of the business, all these are one of the importance or uses of what? Of accounting information or bookkeeping or financial accounting. So if you want to determine your asset or liability or liquidity of the business, just go to the financial statement or accounting information. They will show that. So those are the uses of financial statements or accounting information. And mind you, financial statement is the same thing as accounting information because there you can get lots of information regarding the company. So having talked about that, let's go to users of financial statements. Users of financial statements. Users of financial statements. When we say users of financial statements, don't forget I did say the financial statement will be prepared by the financial accountant, then it will be used by some set of people or group of people to make informed decisions. So those group of people are called users of financial statement. Now these users, another word you can use for them, we call them stakeholders. Stakeholders are those people that have interests, whether directly or indirectly, in the business. So they have interest in the business. It's either they have shares in the company, it's either they've lent the company money, it's either they want to collect tax from the business and so on and so forth. So all these users of financial system, they are also called stakeholders. So for example purpose, most times students will be asked to say internal and external users of financial statements. So let's divide them into internal and external users. So the only internal users you have is the management. Then external users, we have government. We have employees. Most times employees classify as internal too because they work within the company. That's employee. Then we also have shareholders. Shareholders are internal or external? Internal. So they are external users. Shareholders are external users, but some classify them as internal too because shareholders are the real owner of the company. Then we get to explain them one by one. Then we have creditors. We have, this can also be suppliers most times, suppliers. Then we have customers, which can also be metamorphosed into debtors. Then we have competitors, and we have analysts. Yeah, we call them analysts or financial analysts. So let's begin. Government. When you are asked in the exam, I would advise you to explain what each of the entity means or each of these user means before you now start to give why they want to make use of the financial statement. So why would all this make use of the financial statement or accounting information? Number one, government. So government is an entity. Every country has a government. Like Nigeria now, we have federal, state, and local government. So every country has a government. So government is an entity that provides enabling environment for business to operate. But governments make use of the financial statement through some of its agents. Agents like, let's say we have Federal Inland Revenue Service, that's at the federal government level. At the state, we have State Inland Revenue Service. Then we have the local councils that collect tax on behalf of the local government. So let's focus on federal government, that's Federal Inland Revenue Service, that's FIRS. Then we also have CAC, that's Corporate Affairs Commission. They are also one of the agents of government. We have Federal Office of Statistics and so on and so forth. So with respect to FIRS, why would the FIRS want to make use of the financial statement of a business organization? It's to determine the tax liability of that same business organization. Then with respect to CAC, that's Corporate Affairs Commission, that one is in charge of, FIRS is in charge of collecting tax. CAC is in charge of registering businesses and making sure that all the businesses that have been registered complied with the rules and regulation of CAMA, that's the Company and Allied Matter Act in 1990. So CAC will want to make sure that the company has done all necessary registration in terms of registering the business and also complied with the Company and Allied Matter Act. Federal Office of Statistics, you have to know the number of businesses that are in Nigeria and all that. So government will make use of financial statement through its agents, which you have listed: Federal Inland Revenue Service, Federal Office of Statistics, Cooperative Affairs Commission, NDIC, CBN, and so on and so forth. Then employees. So most times the government is often interested, the government agent, they are often interested in maybe profitability. Let's put it that way: profitability, liquidity of the business, and so on. So most of those users of financial statement, the reason why most of them make use of financial statement is the profitability. Then other motives come after that. Then employee. Employee are a group of people that work for an organization for an agreed sum called remuneration. And remuneration is wages or salary. Now, why do they make use of financial statement? Number one is to determine their job security. Their job security in terms of whether their job is secure or not. Number two is to negotiate their wages and salary. And to be able to negotiate, that means, let's say they check the financial statement of a business and they see that the profit of that business has gone up. So by that, they will be able to negotiate new wages and what? Salary with the business. So they concentrate on, or they focus on, the profitability of the business too. Then shareholders. Shareholders. You are watching now. You are watching Echo Plus now. You are shareholders. So shareholders are the real owners of the business, and they are the one that contributes capital. They are the one that contributes money to establish a business or to keep a business running. So the shareholders will make use of financial statements to determine whether the business is making enough profits. Also, whether to determine, also to withdraw, whether to withdraw, or let me say this way, to determine the profitability of the business, also to determine the viability, whether the business is strong enough to continue to exist, and also to determine whether to withdraw their existing capital from that business or to put in more capital. So shareholders, they focus on the profitability of the business, viability of the business, and they make use of financial statement to determine whether to put in more resources of their resources into the business or to withdraw their existing resources. Then creditors. Creditors are those people that the business is owing or indebted to. So those people that you are owing, they are called creditors. And those people that are owing you are called debtors. So the people that, or the individual or the business organization that the business is owing are the what? The creditors. So creditors will be interested in the profitability of the business to know whether the business will be able to pay its debts obligation as at when due. So that's creditor. Why would they make use of financial statements? To determine the ability of the business to pay its debt as at when due. Then customers. Customers are those that the business supplies goods and services. So customer will make use of financial statements to determine the ability of the business to be able to meet their demand for goods and services. So if you cannot meet their goods and services, by checking the financial statement, they'll be able to know whether as a business you can meet the demand for their supply of goods and services. Then competitors. Competitors are organizations that are struggling for the same resources, or okay, competitors are those that are struggling for the same resources in the same market. So let's say in the social media or telecom companies, okay, telecommunication sector, let's say MTN and Glo, or MTN and Nine Mobile, they are competitors. So MTN will make use of the financial statements of Globalcom to determine some of the strategies that Globalcom is using that is making it to do better than MTN. Can you see? Some of them will spy into they will check some of the methods you are using to depreciate your assets, to value your stocks and so on and so forth. Then financial analysts, this one, they are experts. They analyze and interpret the financial statements in order to help, or with the aim of extracting information that will help the users of financial statements to make decisions. So they extract and analyze they extract information by analyzing the financial statements so that they will provide information for users, other users like this, to make what? Decisions. So you see them on TV, on programs analyzing, oh, the financial statement of social companies, and those are financial analysts or experts. Then management. Management are a group of people that manage the day-to-day activities of the business. They run the day-to-day affairs of the business. And they formulate the policies, the rules and regulation upon which the running of the business will be based. Then why did they make use of financial statement? They will make use of financial statement to determine the profitability of the business, the efficiency of the business, and the financial state or affairs of the business. Also, they will make use of financial statements to formulate policies, future policies, to design the roadmap of the business in the nearest future based on the results they have now. They will formulate policies based on the information, that is the financial statement they have now. They will formulate policies, future policies, by designing the roadmap of the business organization. So these are users of financial statements. So this is the only internal user. Then others are external users. But depending, shared employees, some of them classify it as internal. That's internal management and employee. So those are basically the internal user. That's employees and management. But if you say it's only management, no problem. But all these are external users. And don't forget, another word for users of financial statements is stakeholders. And stakeholders are those that have interest in the business, perhaps directly or indirectly. So let's move to who is an accountant. Who is an accountant? Who is an accountant? Who is an accountant? Who is an accountant? I know some of you will want to know. Accountant. So who is an accountant? An accountant is a person who has undergone formal training in accounting and who is a member of at least a member of an accountancy body recognized by the law. So an accountant is a scholar. like I am. I'm an accountant. So that's a scholar. Then that accountant is believed to be at least a member of one accountancy of a body globally, at least one. So examples of a professional body that an accountant could belong. We have ICANN, that's the institute. We have ICANN, the Institute of Chartered Chartered Accountants. The Institute of Chartered Accountants, that's ICANN. Then we have number two. We have Association Association of Certified Chartered Accountants. Chartered Accountants. Chartered Accountants. That's ACCA. And some other uh, accountancy bodies you have worldwide. But this is for Nigeria. ICANN is for Nigeria, like you said. The Institute of Chartered Accountants of Nigeria. Sorry, the Institute of Chartered Accountants of Nigeria. This is for Nigeria. This is British. Yeah. So this is international, but the two are almost the same because ICANN has moved to international standard now. So they are using the same IFRS. That's International Financial Reporting Standard. So the two. So let's talk about some accountants that you have. The accountants that you have. So accountants that you have. So examples of an accountant, like after studying accounting, you can decide to specialize as a accountant. Financial accountant. This one prepares a financial statement of a business organization. That's financial accountants. Then we have cost accountants. Cost accountants, cost accountants, cost accountants, they help to ascertain or determine the cost of running a product, that's goods or services, or cost of running a section, or cost of running a department, and so on and so forth. So this one, they help to ascertain the cost. Then we have number three, we have tax accountants. So tax accountants is in charge of computing the tax and files returns of a company to the tax authority. So he will liaise with the tax authority on behalf of his company. So that's tax accountant. So anything tax that relates with the company and the tax authority, that's the government. Then the tax accountants will do that. Then number four, we have the management accountants. So management accountants, they design, management accountants designs the roadmap of a business organization. They formulate policies. They run the day-to-day affairs of the business. They make decisions, concrete decisions about how the business is going to be in the nearest future, maybe in the next 5 years, 12 years, 20 years. The management accountants make decisions, especially on the information that have been provided by the cost accountants. So the cost accountants will provide cost estimates, contract estimates to the management accountant. Then the management accountants will make decision based on that. Then we have the auditing, the auditing accountants, the auditing accountants. These auditing accountants, they are like the police that's that examine the financial statement that have been prepared by this financial accountant. So any reports, any financial statement by these financial accountants, the person that will look into it by checking whether the figures are accurate, this and that, is the auditor. We call them auditors. Auditors. Okay? When auditors are around, the financial accountants, they're always shivering because most accountants, they might have cooked the books. Do you get it? So when they've cooked the books, the auditor will know Because if we ask the financial accountant lots of documents, so where is the document for this transaction, this and that? If this financial accountant couldn't provide it, then the auditor accountant will say, oh, these financial statements which had been prepared by the financial accountants do not show true and fair view of the business organization. But if the auditor is able to certify the financial statement that have been prepared by this financial accountant, then he will say the financial statements of so 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 EcoPlus Aboy shows the true and fair view of their financial transactions for the past 12 months. So they are usually the police. They police this financial accountant. So that's auditing accountant. So these are some of the accountants you have. So I think at this juncture, you've understand um, bookkeeping, financial accounting, users of financial accounting, importance of bookkeeping, financial accounting, and financial information. You've understood who an accountant is. So at this juncture, I want to believe watching this video this far or haven't come along with me this far means you enjoyed the video. So please uh, subscribe to our YouTube channel and share our videos to friends and relatives so that when next we produce a video, that will come straight directly to your phones. And we are going to be doing real business this time. We are going to be alternating the classes with respect to taking economics class as well as financial accounting class. And we're bringing some teachers to do what they know how to do best. So at Echo Plus, we are customer oriented. We want to give you the best by making sure you all pass your various exams. So to those students that are willing to take WAEC 2025, JAM, uh, 8 years, that's accounting technician scheme, IGMB and all that. So our videos will help you to come out with flying colors. So at this juncture, I want to say bye-bye for now. Thank you all for listening. Bye-bye.